Hi, welcome back to CMGRI Space Forex Lessons. This will be our episode 4, right? So if you are new here, I would suggest that you watch this playlist from episode 1, right? And then you can catch up with this series, right? So we are going to continue from the last episode, right? And this episode is we are going to talk about the candlestick patterns. The previous one was the recent one was on the candlestick. What is actually a candlestick, right? So this episode is going to be what patterns on candlestick patterns. Now, once again, my name is Puju. I'll be your tutor for today, right? And then the whole series is on what? Mastering your candlestick patterns, right? So that is it. Now, candlestick patterns. So when you say a pattern or candlestick patterns, it's just the arrangement of what? The candlesticks, right? One after the other or lying side by side, right? So it's the pattern. And then when you talk about the candlestick patterns, it's usually made of one candlestick or 2 to 3 of that, right? We have some candlestick patterns being one candlestick and 2 candlesticks forming and side by side, and then we also have 3 candlestick patterns, right? We have them. We have a look at them. So it's basically about the formation of the candlesticks and the arrangement of them side by side, right? So that is it. Now, candlestick patterns are one of the most powerful trading concepts, right? They are simple, easy to identify, and profitable setups. Research has confirmed that candlestick patterns have a higher predictive value and can produce positive results. Now, like I said earlier from the beginning of the training or this series, we have some grammatical construction of the sentences and all that, right? The grammatical construction of the sentences. So just don't worry, I'll read them as they should be, but not as it is here, right? So you just be looking at it. I'll just read them. I'll do the correction and read it as on the fly, right? I won't read the wrong one before coming to correct. I will just read it as it should be, right? So candlestick patterns are one of the most powerful trading concepts. They are simple, easy to identify, and very profitable setups. Research has confirmed that candlestick patterns have a higher predictive value and can produce positive results, right? So when you look at the candlesticks like this, for instance, yes, sorry, I had to pause the video for the recording for a sec, right? So sorry about that. Now, so basically we are talking about candlestick patterns, the importance of it, right? And then the how important candlestick pattern is, right? So if you are able to identify the pattern, like I said, candlestick patterns, you should be able to have them at your fingertips. There are about 11 or 15, I think, if I'm not exaggerating, right? They don't be alarmed. They are simple to learn. In fact, get them visualized, right? At the back of your mind. So if you're able to know these patterns, whenever you open your chart, when you see them, it's going to help you identify or know when to enter the market, exit the market, or even wait, right? They give you that higher predictive value. You're able to predict, anticipate what is going to happen, right, in the future because of what? The history that you have. The charts give you the history, how prices moved, right? How the buyers and sellers reacted in the market. So that is it. Now, it says, I personally trade candlestick patterns for more than 20 years. The disclaimer is still in play. I am not talking about myself. We are talking about what? The writer of this book, the author of this book, right? So he has used this book for 20 years, or maybe the publisher or the editor of this book. Now, I can't really switch to another method because I tried thousands of strategies and trading methods with no results. So it means that technical analysis is very important, right? It's very important and then very, very imperative. It has a lot of benefits. Now, I am not going to introduce you to a holy grail. This trading system works, but be prepared to lose some trades. Losing is a part of this game. If you are looking for 100% winning system, I highly recommend you to stop trading and go look for another business, right? So a holy grail here in the sense means that it's not like a bed of roses. We are not always going to win trade. You are not always going to win trade. Your winning percentage is not going to be 100. You lose some trade and then what? You win some trades, right? So the important thing of it is that you should know your risk management, right? How much you are willing to lose the market, and then in relation to whatever you want to gain. So we have something called risk to reward ratio, right? So it's very important that after doing the technical analysis, we move on towards the management aspect, then move toward the psychology of it, right? So you are going to, you will not have a winning system like 100% always winning, and you will not always be always losing, right? So you just have to find your niche. Whatever works for you, you capitalize on that and then do it very well, right? So if you are going to become a better trader, a good trader, what you have to do is have your basics at your fingertips, right? So that's what you are going to look at. Have your patterns off head. Some of them, I even recommend that you have to draw the charts, have pictures of them pasted in your room or maybe on your phone, right? So the moment someone displays, the moment you see them on the charts, you know that this is such a candlestick pattern, and then the importance or the implications that you're going to have in the market or in the near future. So that is it. Now, candlestick patterns are the language of the market, right? We have seen that already. They are language of the market. Imagine you are winning. Imagine you are living in a foreign country and you don't speak the language, right? You are living in a country and you don't speak the language. How will you be able to communicate? That means you're living there. It's going to be like hell, right? So in order for you to communicate well, feel okay, feel at home, you have to understand the language, the grammar of it, right? So basically, trading is a profession, it's a language, and then the grammar will be like the technical analysis, your patterns, right? So that is it. Now, how could you live if you can't even see a word? It is tough. It is tough, right? Now, the same thing when it comes to trading. You have to know the basics, have your facts, have the rudiments. That is it. Now, if you know how to read candlestick patterns the right way, you will be able to understand what these markets or this pattern tell you about the market dynamics and the trader's behavior, right? You will know what is happening, their reactions of the buyers and the sellers. This will help you better enter and exit the market in the right time, right? In other words, this will help you act differently in the market and make money following the smart guys' footprints. When you say the smart guys or the big boys, we are talking about the big institutions, right? The banks, the hedge funds, financial institutions, right? All that. Any financial institution, we call them what? The traders, we call them the big boys. Now, the candlestick patterns that I'm going to show you here are the most important patterns that you will find in the market. In this chapter, I'm not going to show you how to trade them. In this chapter, for instance, we are not going to show you how to trade them, but we are just going to show you them, what they are, right? The implications, and when you see them, what they mean at a particular point or section of the chart. If you see them at the top, at the down, or maybe somewhere in between, whatever, when you see them, every part or every place that they find themselves, they have meaning, right? What they can actually do there. Now, what I want you to do is to focus on the anatomy the anatomy of the pattern, and the psychology behind its formation, right? Because this will help you get a skill of identifying easily any pattern you find in the market and understand what it tells you to do next. If you can get this skill, you will be ready to understand and master the trading strategies and tactics that I'm going to teach you in the next chapters, right? So the first candlestick pattern is going to be the engulfing bar candlestick pattern. The engulfing bar candlestick pattern, right? Now, this candlestick engulfing, we have two types of it. We have the bullish one and then the bearish one, right? We are going to treat them under this engulfing. The engulfing bar is of two types, the bullish and then the bearish. And this candlestick mainly consists of two candlesticks. Like I said, the candlestick patterns can be one candlestick being a pattern, two candlesticks together being a pattern, or three being a pattern, right? So for the engulfing ones, most of the candlesticks are going to be double, like two candlesticks lying side by side, right? Most of them. Some two are one, and then others are three, right? For the engulfing, it is two candlesticks, right? Now, the engulfing bar, as it states in its title, is formed when it is it fully engulfs the previous candle. So we have a candlestick, we have two candlesticks lying side by side. We have the first one being on the left, and the second one lying next to it being what? The right one, right? The engulfing bar can engulf more than one previous candle. But to be considered an engulfing bar, at least one candle must be fully consumed, right? So we are going to look at the bearish engulfing one. It's one of the most important candlestick patterns, right? The candlestick pattern consists of two. This candlestick pattern consists of two bodies. The first body is smaller, right, than the second one. In other words, the second body engulfs the previous one. So the word here, engulf, means it just overshadows, right? It overshadows, or maybe it's bigger. Engulf, bigger, as in overshadowing the other one. That's the literal meaning for that, engulfing. So the candle that engulfs the other is the second one. The first candlestick on the left is a small one, right? So the same thing applies to what? The bullish one, either the bullish or the bearish. No, always the second candle is the bigger candlestick, right? That's what you have to use. That's what you use to identify whether it's bearish or bullish, right? So let's do it. So now we are still on the bearish engulfing bar, right? Like I said, the first one is a smaller one, and then the second one is a bigger one. You understand? So, but how will you know this is an engulfing bar, bearish engulfing bar, or the bullish engulfing bar, right? So usually we are representing the second candlestick to be what? The bearish one. Hence the name bearish engulfing, right? Bearish engulfing, hence the name bearish engulfing. So the second candlestick is a bearish candlestick, and the first one is usually what? The bullish candlestick. Now, notwithstanding, right? I know it can be confusing, but bear in mind that the colors does not matter, right? Like I said earlier, or said earlier, the color does not matter, right? The color of the candlestick does not matter. We are going to look at what? We look at what? The opening and then the closing of the candlesticks that we are talking about. But for time's sake, right, we just going to represent the colors of the candlestick with the red and then the black. Sorry, the red and then, yeah, the red and the green, and or the white and the black, right? So we are still using the black for the what? The bearish one, and the white for the bullish one, right? And I said for the bearish engulfing, always the bearish candlestick is the second one, and it's a bigger one, and it engulfs what? The first one. So I hope that is understood, right? So still, you look at the opening price of them, and then the closing price of them. To realize that the opening price is at the top, and then the closing is at the down. That makes what? A bearish candle. That is it. And then we have the bullish one down, and then at the top. That's a smaller one. So always look at the body of the candle. So your main focus should be on the what? The body of the candle, the size of the candle, the candlestick, right? Before you come to the color. But if you have already represented the colors already with the colors that you think they are convenient, then you can just stick to the colors. So don't get it twisted. Don't be confused with the colors, right? So for convenience, you are going to use the colors to represent whatever type of what candlestick it is, either bullish or bearish. So I hope that is understood. So whatever you want to read under here is just simple thing, right? So you have to have these things printed in your memory, right? Printed in your, you have this in your mind. The moment you see such a pattern, you know that this is a bearish engulfing bar candlestick pattern. So that is it. Now, this is how a bearish engulfing bar pattern looks like on the charts. This candlestick pattern gives us valuable information about bulls and bears in the markets, right? Now, in case of a bearish engulfing bar, this pattern tells us that sellers are in control of the market, right? Sellers are in control of the market because if you realize that if you look here, look at the candlestick, this is very big, and we learned earlier that the size of the candlestick, right, which is the height, shows the pressure of what? The buyer of the sellers, right? So this is what you have to get in your mind. This is a higher selling pressure here because it is bigger candlestick. It's a bigger candlestick as compared to what? The first candlestick, the previous one. So I hope that is understood. Now, when this pattern occurs at the end of an uptrend, this indicates that buyers are engulfed, means buyers are overpowered, right? Buyers are overpowered. And then by sellers, which signals what? A trend reversal, right? So when you say a trend reversal, a reversal means what? Whatever previous direction the market was moving, either up or down, is meaning what? It's been changed, redirected, right? If it was moving up, it's now going to move downwards. If it was moving downwards, it's now going to move upwards. That's the meaning of what? A trend reversal. Get this at the back of your mind. It's a term that we are going to be using often. So get it once and for all. Trend reversal. Whatever direction it was going, it's going to change. That's a trend reversal, right? So let's take it again. So when this pattern forms at the end of an uptrend, this indicates that buyers are engulfed by sellers, which signals a trend reversal. So that is like we said again, we have about 4 types of what? Market structure, right? The market either moving up or down or is ranging. And then we have the 4th one to be what? Choppy one, right? So I won't bore you now. I won't bombard you with too much of information. No information overload, right? But I'll just be giving you foreknowledge about whatever we are going to treat ahead, right? So now the reason I'm saying this the reason I'm saying this is because now there's a term like upward and then a downward, right? That is being used here. Uptrend and a downtrend. That's what I'm going to talk about briefly. So here we are going to talk about what? The uptrend and the downtrend of a market, right? So if it's an uptrend, meaning the market, the prices started moving from the bottom and then moving up. So that is an uptrend. And then if market is in the downtrend, that means it started from what? The top and is now moving down. Based on the time frame or that portion of the market that you are going to analyze, right? within that section that you're going to analyze, the beginning of that portion to the end of that portion, that's where you are analyzing. So you can realize that, okay, this is an uptrend, or here is a downtrend, right? So that is, so is that, and now one thing I have to draw your attention to is that candlestick pattern, after there are stages of what? Dealing with candlestick patterns, right? Now you have to understand the anatomy of that candlestick, that's the formation of that candlestick, and then where it is formed, right? Candlestick formation pattern can be formed at any part of the chart, right? It can be formed at any part of the chart, but there are some places on the chart that when they form, they have what? A massive impact, right? They have a massive impact. So you have to look at that. You have to look at that well. You have to understand that a candlestick can form at any part of the chart, but they will not have the same impact on the market or on the prices. So you have to take note of these phrases at the end, right, and at the beginning, and then uptrend and downtrend. So when we talk about candlestick patterns, these are the terms that you have to look out for. The phrases, right? The beginning of an uptrend, the bottom of an uptrend, and you see, those things, you have to get them, because candlestick can form at any part of the chart. But where it is formed will have an impact or not. So that is it. So for a bearish engulfing pattern, right, we are saying that when we see such a candlestick formation, right, form at the end of an uptrend, this indicates that buyers and sellers are engulfed. They are overpowered by what? Sellers, which signals a trend reversal. So whatever we are talking about here, let me simplify them so that you understand. Now, when you say an uptrend, right, this is an uptrend, right? Because prices what? Started from here, they moving in that sense, to that point, right? So this is an uptrend. But when we got here, you see that we are at a level that is a level that is even, right? So when this actually formed, this is the pattern. The pattern is going to be indicated in what? In red ink, right? So this is what? Fully bearish engulfing bar, right? Bearish engulfing bar pattern. Look at this very well. This is the black or the bearish candle, and this is the bullish one, right? And this one is bigger than the first one. So this makes what? A bearish engulfing candlestick pattern, right? And then we are talking about where when it is formed, it's going to have a great impact, right? So the book said that if it's formed at the top of an uptrend or at the end of an uptrend, then there's going to be a trend reversal. So meaning that initially the prices were moving up. By the moment this formed, this candlestick pattern formed, you realize that the prices started what? Moving down. So meaning buyers were what? In control of the market. Buyers were pushing the market up. The buyers were pushing the market up until this candlestick pattern was formed, which means that the sellers came into what? Into play with much momentum, much pressure, much effort, right? More money being pumped into the market. So when this is formed, the sellers took charge and they started. The sellers took charge of the market, and they started pushing the market down. So that is the meaning. So when this is formed at the bottom, they have a great impact. Now, bear in mind, I was saying something like where it is formed is very important, right? So it means that this particular pattern could even be formed here, right? Anywhere here, anywhere actually here. Anywhere here, right? But it may not have that effect. Effect of what? Pulling the market down, right? They could even form here, but they will still not have impact, right? Their power will be overridden, and then the market will still, the prices of the market will still move forward, right? But when this is formed at the top of it, then you realize that price will start moving down. Then someone may also tell me or ask that, how will you know that this is the top of what? Of a trend or the end of an uptrend, right? Someone who has foreknowledge about the candlestick patterns already may even comment and ask, how will you know that this is the top or the end of an uptrend or the end of a downtrend or the beginning of an uptrend or whatever? How will you know? Now we will treat something we call support and resistance, right? Support and resistance level. They are horizontal lines drawn at a particular portion of what? Of the price on the chart, right? Yes. So with these lines, they will actually help you know that this is the end of an uptrend or the beginning of a downtrend or whatever. So with these lines, you get to know, right? So even though the lines were not drawn, because I have idea about trend lines and then support and resistance and all that, I was able to identify that this is actually at the end of what? An uptrend. So that is it. We will treat them in index. So just follow closely. So that is it. Now let me also draw your attention to uptrend and a downtrend, and then shopping markets and ranging markets, right? I'll just give you a glimpse of them, right? As in just an idea, a fair knowledge of that, right? So that when I start using them, when I continue using the terms, you'll not be confused too much, right? Before you even get to the actual treatment of that. So an uptrend of any market or a price or a chart is something like this. Actually, something of that sort, right? They move this way, pricing move this way, move this way, move this way. Because now one thing you have to know that market does not move in a straight line. Price does not move in a straight line. Like this, they don't move in a straight line, right? They move up a bit, they come down a bit, move up a bit, come down a bit, move up a bit, and then come down a bit, move up, come down a bit, move up, come down a bit, move up, come down a bit. But in general, looking at this critically, you realize that prices are moving up. It's like a ladder, steps. They are moving up. Average in general, prices are moving up. Even though within the channel that I have drawn here, you realize that the market was moving up and come down, moving up and coming down. Yet, in general, you realize that the market is actually moving up, right? So prices and candlesticks does not actually form like this. Maybe green here, another green here, another green here. You will hardly see such formation, right? So a green will form here, actually. A green can form here. A red can even come and form here. Come here before a green will come again, right? So in that sense, then it will be moving up. The same way, so this is what? An uptrend. This is an uptrend, right? Now, the same way we have what is called a downtrend. Downtrend. So meaning that one also move this way, in this sense. Move this way, in this sense. Move way in this sense. Move way in this sense. So this is an uptrend, and this is a downtrend. Downtrend means the sellers are pushing the prices generally down. And then uptrend, the buyers are what? Moving the markets up, right? So this is the two, the when it comes to the trends, uptrend and downtrend. Now the third one is what is called a ranging market. The market is just ranging. The market is not moving too up and too down. It's not moving too up or too down. It's moving within some boundary, right? The market is moving within some boundaries. So the market will be like this. It moves there, gets here, bounces back. It moves there, goes up. It moves there, comes here. It moves there, goes here, comes here. So the market moves in this sense. So this is what we call what? The ranging market, right? The market is ranging. Or another name is what called consolidating, right? The market is consolidating. The market is consolidating. The market is consolidating or ranging. Yeah. Right? RANGING. Right? The market is ranging. Then we have the fourth one, which you should always avoid. You should not even bother yourself trading them, because in such market it's very dangerous, right? It's very, very dangerous, not advisable, because if you try, you are always going to lose what? Money. So market, sorry. Sorry, yeah. So market move in that sense. It's very choppy. The market will start from this. Let's say you have excuse me, market price will start from here. It moves up a bit to this point, right? Then the next time you realize that the market comes here, come and close something here, and then also moves up like this. You see, like haphazardly, very rough. There's no particular trend, no particular formation. Whereas the market moves anyhow. So when it happens this way, don't worry, I will give you pictures of that. You actually deal with them, right? You have time to treat them. Market moves anyhow. It moves up, moves out. So if you try to find a boundary or maybe draw some trend lines and then try to do analysis, realize that the price can move out of that boundary or that range and then even comes back to the same point, right? And that is very, 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 very costly. You don't have to try trading such market. You will always lose money. So that is it for the type of market structures, right? So we are going to move on to, we are going to continue. Now, as you can see, when this price action pattern occurs in an uptrend, right, we can anticipate, as in we can guess, we can predict a trend reversal because buyers are not still in control of the market and sellers are trying to push the market to go down, right? So it happens that it goes up, this one forms, then the market comes down, meaning the buyers are no longer in charge. The sellers have taken control of the market. So yeah, that is it. Now you can't trade any bearish candlestick pattern you find on your charts. You will need other technical tools to confirm your entries, right? So besides that, there's something we call confluence, right? Even though you will see this formation forming at the top of a pattern, or in fact at the top of an uptrend, you see them at the top of an uptrend, and you know already that when you see them, that shows that there's a higher probability of what the market was, the pricing moving down. The probability is not always what? 1. Probability is out of 1. Like 100 is out of what? Percentage is out of 100, right? So it doesn't mean, like we have said already, because when the pricing start moving up and you see a candlestick pattern, in fact, an engulfing candlestick of a bearish one at the top, and then you think you can always sell. No, it's not like that. Sometimes you have to have one factor, then wait for another factor to confirm whatever you have seen so far. That's what we call a confluence, right? So you have a number of factors coinciding, agreeing with each other, then you can actually take your trade. That's what we call confluence. So looking at a candlestick engulfing and bearish engulfing happening at the top does not give you the full assurance that you can always sell or the market will always come down. It doesn't happen that way. So we are dealing with what? Probability. So there's another term called a higher probability setup, meaning we have many setups around, right? Many probability setups around, but we are looking out for what? The highest one, the higher one, right? The highest probability setup to trade them, because there are a lot of signals that are happening in the market. some are fake, right? Some are noisy. You see them and you think the market is going to go that way. By the time you realize the market moves in the opposite direction, right? And you think you are always wrong, or maybe trading is not your calling. No, there are factors that you have to consider before you can actually take a trade. So that is what the last portion is what telling us. You can't always trade them, even though you have been told. You have to look at other factors. So that is it. Now, well, we will talk about this in details in the next chapters. Right now, I just want you to open your charts and try to identify all bearish candlestick patterns that you find. Right? So you can even sign up on TradingView, right? You don't necessarily have to trade them, right? You don't necessarily have to start trading, but just for learning purposes. I will actually take you through how to trade, do your setups and all that, right? But for the TradingView, actually, that's where you do the analysis, right? So you can sign up using your Google account, right? You just sign in straight with your Google account and then you see all these things. So you look at them, or better so you don't even have to even sign up, right? I don't want you to maybe go ahead of us and then get confused. You can even Google, right? Google, just search bullish engulfing bar patterns or bearish engulfing bar patterns, and then you see all this information there, right? So that is it. So you continue with what? The bullish one. Now for the bullish one, it also consists of what? 2 candlesticks, right? Still, the first candlestick on the left is the smaller one, and then the second one is the bigger one, right? Now, the bigger one, being the second one, is the bullish one, hence bullish engulfing bar, right? You have to get that in your mind. Just find a simple way to learn. This is not difficult. Just relax, right? So the bullish candlestick, the engulfing one, if it is bullish engulfing pattern, the bullish candle comes last. For the bearish one too, the bearish candle comes last, and they are always the bigger candlesticks in that formation, on that pattern. So that is it. Now, the bullish engulfing bar consists of 2 candlesticks. The first one is small body, and the second one is engulfing candle. So just looking at the illustration, just simple, right? The opening is here, and then the closing is at the top. That makes this candlestick a bullish one, right? Besides the fact that the color is what represented with what? With white or maybe green, and here is red or black. So that is it. Now, bullish engulfing pattern tells us that the market is no longer under control of sellers, and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, right? Here we are talking. So now we have described what a bullish candlestick pattern is. In fact, a bullish engulfing bar pattern is, right? So you have to first look at that, what it is. Then you look at where, when they form, they have the greater impact, right? We have described them. We are going to see where the formation happens and then the impact that it has, right? So now, when a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal, right? A continuation signal. Now, when a bullish engulfing candle forms at the end of an uptrend, right, the reversal is much more powerful, as it represents a capitalization what? Bottom, right? So I'm going to explain this. Now, we have already looked at the bearish one, so I'm not going to confuse that. I'm not going to talk about it again. I'm going to continue with the bullish one, right? So we are also saying, let's move to what? Right? Now, the bullish, looking at this is what? A bullish pattern, right? A bullish pattern because, one, the candle here, we have a small body and a bigger body. The bigger one is what? the bullish candle, being the color being white, and then the first one being what? The black or the red. Now, looking at this, we also talk about where when it's formed, they have what? Impact. So now, reading from the previous statements, it talks about what? When it is formed in an uptrend, right? And then when it is formed in a downtrend, right? So now, we are saying that when it is formed in an uptrend, or yes, in an uptrend, it means that the price is what? It is going to continue, right? It's bullish, right? The trend is what? An uptrend is what? A bullish trend. Get that one too in your head. That an uptrend is also a bullish trend because prices are going up, right? And then it is in a bullish trend, and then we have also find what? A bullish engulfing what? Pattern in it. So this tells us that the price is what? There is a higher probability that the price is going to continue what? Buying, continue going up. So that's the meaning. It is as simple as that. So when you see a bullish engulfing pattern forming in an uptrend, there's a higher probability. We are saying probability. Take note. There's a higher probability that the price is going to continue moving up. That's one. Now, when you also see them at the end of, when you see them at the end of a downtrend, right? At the end of a downtrend, it means that there's going to be a trend reversal. That is it. If you see them at the end of a downtrend, then there's what? A trend reversal going to happen. I told you a reversal means if the price was going down, it's going to go in the opposite direction. That's a trend reversal. It's as simple as that. So when you see a bullish engulfing pattern forming in an uptrend, there's a high probability that it's going to move up. When you see them down, then the price wants to what? Reverse. So meaning if the price was going down, now it's going to what? Move in the opposite direction by going up. So that is, so anything bullish means price is going to go up. It's as simple as that. Get this in your mind. So that is it. So that is the graphical representation. So you realize that prices was what? Moving down. Moving down until this formed with the help of what? A support line, right? This is an imaginary support line. Don't worry, we'll treat that. So if it's at the end of it, then what is going to happen? The price is going to reverse because like we read just now, it is from at the bottom, price is going to what? Reverse and move up. So this is what is happening, bullish. So the price starts what? To move up, going up, right? So that is it. But if it was formed along a buying trend, right? The price is going to what? Continue moving up. So that is the meaning. Now, the example above shows us clearly how the market changes direction after the formation of a bullish engulfing bar pattern. The smaller body that represents the selling power was covered by a second body that represents the buying power. The color of the bodies is not important. We have looked at that already. What is important is that the smaller body is totally engulfed by the second candlestick. Don't try to trade the market using the price action setup alone. When you say a price action setup alone, price action setup, it's just a matter of the price moving up or down or whatever, ranging. So that's the price action setup. It's going up, going down, or ranging. That is it. So in general, if you have when you open your chart, right, you don't need any special eye to see this. When prices are moving up, you see that the prices are moving up. When they're going down, you see that they are moving down. And then this book is telling us that when you see price moving up in that sense, you can't trade that alone, right? You have to look at something worldwide, like I've said earlier, factors of what? Confidence, right? So you actually have to know where or when to enter the market. Because market moving up, we know that generally, we know that when prices move up, it means prices you can buy. That's the norm or the traditional idea, the simple idea that if market are moving up, you can buy. If they are moving down, you can sell. But the point is, where do you enter the market, right? They are moving up. You can't just jump into it. You have to know where you can enter the market, right? So that's the importance of it. So if it is moving up, you can't just trade that price action. You have to check and then know where or when to actually enter the market. So that is what he's saying here. Now, what I want you to do now is to get the skill of identifying bearish and bullish engulfing bar on your charts. This is the most important step for the movement, right? So you just have to know them, right? The moment you see this pattern, you know that, oh, what kind of pattern is it? Bear in mind, as we proceed, there will be some short exercises ahead that you should be able to identify if this pattern is engulfing, in fact, a bullish engulfing one or a bearish engulfing one. You should be able to identify them easily. If you are not able to do that, then that means you have to go back to the previous videos, right? And then learn them and come back. Don't skip any part of this video. If there are some point that you didn't hear me well, just relax, right? And then play the video once again until you actually grasp the whole idea, the whole concept. There are times you may need to what? Text me, right? Privately, or I have my emails and numbers there. You can email me for whatever information, some point that maybe I attached, but I didn't really explain them. I can actually explain, do a full video for the whole, this particular intermediate level. But the point is, you have to take them step by step, right? So that the information will not be overloaded, right? So some of them, I'll just touch on them and then explain them later. So just take note of that. There are some points you see that maybe you need to learn ahead, and then you email me or you text me or whatever, or you any call, I'll attend to you, or whatever you need to know, I'll let you know. So this will be the end of this episode. So thank you very much. And then don't forget to subscribe to our YouTube channel and other social media platforms. And then we also provide private sessions, right? Private session that you can learn from us. You can contact us and then, or even check in the description. And then we get back to you. Thank you very much. Bye.